This next podcast could not be more relevant, guys. I know interest rates are skyrocketing and people are questioning, what should I buy real estate? What are the interest rates doing and where are they going to go? Well, my buddy Jimmy Vreeland is the only one screaming, this is the best thing for America and this is the best thing for our investors. So check out the podcast coming at you right now. Fired up for this episode, guys. Welcome to another edition of this podcast between Jimmy and Mark, not only on Rise Up, Live Free, but the Mistake-Free Real Estate Podcast episode. I was complaining the other day. Everyone's hearing interest rates are rising. They've gone from 3% to over 7%. They've just taken a slight regression back down. So we've got interest rates in the sixes, but guys, they've doubled in 1 year. And there's one guy screaming from the rafters that this is a good thing. So I'm bringing him on the show right now. Jimmy Vreeland, welcome. What have you got to say about these interest rates, mate?
It's awesome. It's incredible. If you're a turnkey investor looking to build a portfolio, now is the time.
Okay, I'm going to count it. This is craziness.
When interest rates are at 3, you could not build a portfolio.
This is craziness. Everyone's going to be trying to absolutely undermine your thought process here. So I'm gonna come at you from the devil's advocate position, at least from the start. And I need to get your top 4 reasons why you believe that this is a good thing. So everyone out there that's going to say, Jimmy, you're silly. You're just trying to sell me something. I don't understand why rising interest rates are good. What is your number one reason, brother, why this is a good thing?
It's clearing the field.
Define.
Okay, so 2 years ago when interest rates are at 3, I had everybody complaining, oh, there's no deals out there. CNBC, we have a housing shortage. There's no deals out there. So I had a bunch of dejected buyers saying, I'm never going to be able to get into real estate. I'm never going to be able to do this. And what they were really saying is, I'm never going to get the long-term benefits of real estate because I can't even get in the game. That is not true anymore.
Yeah, we actually saw that. We had so many investors, and that's actually been maybe a flaw of our business model, is we scaled so quickly to try and cater to that need. And I will say that, it was just hard to buy. And now that the market is corrected, we're actually selling discounted properties to our investor group, losing money on assets just to get them off the books because they're still valuable turnkey assets, but just not at the price that we had hoped. So it's definitely clearing the field. There's a lot of investors in our market, Jimmy, that are no longer playing the same game. Are you seeing that in St. Louis?
Yeah, I do acquisitions. I look at the MLS every day, and I am just straight up lowballing everyone, and I'm loving it, and I'm getting responses back.
Yeah, it's interesting. There are instances where the refi business has gone away as well, clearing the field. Look at the mortgage and how the mortgage and title businesses have now responded to us. We suddenly don't look like the ugly redheaded stepchild anymore, do we?
No. So my main complaint from buyers in the last 2 years was there's no deals. And then there was, my mortgage guy won't talk to me. And of course the mortgage guy wouldn't talk to you because he was working on his refi business. Mm-hmm. And I think that was short-sighted from the mortgage industry, but hey, when the sun was shining, they had to do what they had to do. But now your mortgage guy is bored. I saw my mortgage guy at the gym, and your
mortgage guy's now working at the gym.
Oh, he's not that far off, but he was like, why couldn't they have done this in the summer? I got nothing to do. At least I could have golfed if they would have raised it faster in the summer.
Yeah, no, there was a company that completely went out of business. In all seriousness, the mortgage industry has been decimated. Those that had 98% refi business, they've just shuttered their doors. So, yeah, it's been a very real thing here in Kansas City.
Yeah, you're a very pretty date right now.
Yep.
If you're an investor with impeccable credit, high net worth, you are their dream. You are going to I've always believed turnkey would save the real estate industry. It could pretty much save the mortgage industry.
Well, Jimmy, when you buy a house, are you locked in with that interest rate for 30 years?
No.
Oh, wait, you can refi?
Yep.
Bingo.
My belief, it doesn't matter what the interest rate is. It just matters that it's fixed. The reason people got hammered in 2008 because they bought long-term assets with short-term financing. So they created those balloons and those variables, and that's why you saw people get hammered. But if you can come into an asset now and your interest rate is fixed, your cost of capital will never go up. It can only go down.
Okay, number one, clearing the field. There were no deals, and now there's deals galore. Number two, what's your number two reason?
Let me hammer on one more thing about clearing the field too. Okay. Is like I was most nervous last year's Super Bowl. Do you remember that? I think it was a Quicken Loans thing where cash buyers actually made a Super Bowl commercial.
Yeah, the Rocket Mortgage or whatever people.
Yeah, that made me so nervous because it's like I would hop in an Uber and they'd hear me on the phone like, "You in real estate?" I'd be like, "Yeah," and they're like, "Oh, I'm in real estate too." I just put in 3 offers, which were uneducated, undisciplined offers, which were beating my educated and disciplined offers. So, why is that important to a turnkey investor? Like, you are the buyer in town now. Like, you have the deal.
So you were competing literally against your Uber drivers that were putting in offers. I mean, everyone and their dog was a real estate investor, right?
Yeah, and they were undisciplined, uneducated offers. And like my team would get mad at me and like, why aren't we outbidding them? I'm like, no, because whenever this turns, we're going to buy all their foreclosures.
Heard, mate. Number two, what's your second reason?
Price protection. Like this is what I believe is happening is pricing is leveling out. What are you seeing? We're not seeing appraisals come in any lower. We're not seeing any price dips on the east side of the state. What are you guys seeing?
We are seeing, a small amount of price. I'd say 5%, maybe 10% on some of the bigger stuff, but not the turnkey stuff.
Yeah, the turnkey model, the price is leveling and the rents are still going up.
Yeah.
So, like, let's say you're like, I'm going to wait till interest rates go down. Price is going to shoot up again. Like right now, you're locking in your cost of capital, which will only go down over time. And you're locking in at a leveling price. Like Mark, they still printed a third of the entire amount of money that's ever been printed in the last 3 years. That cash is still on the streets. Like, you're not going to see significant 08 price drops. There's just too much cash in the economy right now.
Well, to that point, one of the things that I got asked on a social feed the other day was the foreclosure crisis. Is this like '08? And so I just pulled down the latest data, and it's literally the lowest foreclosure rates that there have been in, I think, 15 years. I went and looked. So rather than just taking graphs and charts, for example, I actually went to the foreclosure websites. As everyone knows, I was buying on the courthouse steps for about 17 years. And so I went to all of the attorneys that are crying those sales. And normally there'd be, in the peak, there'd be like 500 a week that I'd get to look at. Then it would be like 300 a week, 200 a week. I went and looked there other day, Jimmy, there were 5. Five houses in foreclosure. I mean, on one website, there were 5. On the other attorney's website, there were 4. And none of them had opening bids. I'm just saying there is no relevance at all to thinking this is going to be a foreclosure crisis because, let's face it, everyone has 30-year fixed debt and 3%. I mean, there may be a lack of volume of sales because people are just not going to move as frequently, but this is not a foreclosure crisis.
Yeah, so we had already an inventory shortage when the market was super hot. Now you have people who have mortgages at 3%. Like there's not going to be a huge glut in inventory to lower prices.
Yeah, and I'll also add too, what happens when fewer people are buying? What are they going to do? They start renting, right?
Yes. So if you buy now, you're buying the price leveling, and you're going to benefit from the rent the continuing inflation crisis and the rent rising over the next 36 months.
Price protection. Okay, I'll give you that one. You say you've got 2 more. What's your third?
Well, this is from more of a macroeconomic stance, but like why do interest rates go to 0, Mark? Is it because things are good?
No, it's because they're bad and they need to stimulate growth in the economy, right?
Yeah, if your plan is to only invest in real estate when interest rates are 4% or below, like it's bad karma. You're wishing horrible things on the society in general. Let's take a quick history lesson of when interest rates have gone to 0. One was 9/11, not a good day. Don't want that to happen again, right? Next was 2008. No one wants to go through that again, right?
Never.
And finally, a pandemic. So, do I think interest rates will go to zero again one time in the future? I do, but I know there's going to be hell to pay for that. So, you cannot create an investable long-term strategy of building a real estate portfolio if it's dependent on interest rates being below 5.
Here's what I love about your perspective is you've got that salty war veteran thing going with you, you know, where
I remember 9/11. That was a bad day, bro.
Yes, dude, I agree. My brother was in New York on that day, and it scared the hell out of me. And then the ramifications of realizing that we were under attack was, it's a sobering moment for sure. But kudos to you and your buddies that went to defend us. Appreciate all of the hard work that the veterans in this country do. And to your point, as a patriot, 0% interest rates means something is going massively wrong in the country.
Yeah. Again, quite frankly, to really, truly benefit from 0% interest rates, you have to already own the asset. Because I know when interest rates went way down last time, you and me, our first call towards our banker to refi everything.
Yeah, and to your point, when interest rates is zero, I mean, prices go up. You know, there's just more demand. Prices are going to go up. So to that point, you're saying, again, with the price protection, you know, kind of point number 2, coming into point number 3, these are interwoven. The time to buy is now, you're saying, because when interest rates come back down, the prices with which they have entered the market will only be able to go up.
Correct. And if you really want to benefit from low interest rates, you have to already own the asset. So you can refi everything at once. You can't deploy. You and me were at several dinners the last 2 years talking about our clients' main problem is that they cannot deploy their capital fast enough to benefit from low interest rates.
Yeah.
So that's why, you know, you and me have always been proponent. We do in our own portfolios is you decide on a certain amount of assets you're going to buy every year, and then you execute on that plan regardless of the interest rate.
You know, it's interesting talking about the American dollar, that it is stronger right now. I'm getting ready to head back to New Zealand, and I deployed some capital back there because I thought that it was the right time to do it back in July when there was a little bit of a dip. And I bought. It normally takes about 75 US cents to buy 1 New Zealand dollar. And so I think I got in at like 69 cents thinking that was a good deal. And it obviously converted to more NZ dollars, NZD. But right now it's at about 55 American cents to buy 1 New Zealand dollar. The American dollar with where we're at is extremely strong. It's actually improved, with these higher interest rates.
So that's what I'm saying. The rise in interest rates is an indicator that the Fed is adding more gas in the tank. So they're saving up for the next crisis. Because here's when economies fall apart, is when interest rates are at zero. And then this comes straight from Ray Dalio. If you want to read further on it, it's in
Principles.
It's big debt crises. Mm-hmm. So it's big debt crisis, and he's got a great YouTube video on how the economic machine works. But essentially, the central bank has one lever to pull to set things straight for 360 million Americans. Now, me as a libertarian, I say that's a little silly that we're going to give a group of central planners the ability to control the economy for 360 million people. But that is a topic of a different podcast. But the only lever they have to pull to juice or slow down the economy is the interest rate. And when economies fall apart is when interest rates are at zero and they got no gas left in the tank. Then the economic planner's options, the government option is to restructure debt, default. Nobody wants the American government to default. Then the American dollar loses all its value. Their next option is stimulus payments, where they just put cash directly into the hands of its citizens. That's horrible for inflation. It's also still politically unpalatable because it's still somewhat Marxist. But if the really scary part is if in COVID, when interest rates are at zero and the economy had fallen apart then, we would have had some major economic restructuring. So what I'm saying is the rise in interest rate is good for the American society because it's adding more gas to the tank for the next time there is a
yeah. No, I hear you on that. I feel like when interest rates were at zero, the government effectively had only the use of the accelerator, not the brake. Like they couldn't slow down. So they had to, it's kind of like driving down and you can only use the accelerator or the brake. Now that interest rates are at 7% or the Fed fund rate somewhere in the 4 or 5%, they have the ability to push both the accelerator and the brake, which is a healthier economy.
Absolutely. So it's the subject of a different podcast, but what happened the last 2 years was not healthy. It was like getting drunk.
Yeah.
Like we were on a 2-year party, and sure, we're all feeling a little hangover right now, but at least we're sober.
Yeah, it's kind of like, your kids go off to college, and rather than teaching them how to get a job and earn money for themselves, the parents just throw $20,000 at them and say, hey, go have fun. But when it runs out, there's a hangover, right? And now they've got to figure it out. I mean, the government just threw money. Helicopter money came to everybody. And now we're, in the ramifications of dealing with that.
And if you have a business model based off of that drunkenness, you're going to see that on CNBC, that some people are going to hurt now that we're all sobering up. But not turnkey buyers.
Not turnkey buyers. All right, we got clearing the field.
Investors.
We got price protection. The American dollar is stronger. You've got one more point for me, mate. What is point number 4?
It's just we've been continuing to hammer on it. A piece of single-family real estate is the greatest inflation hedge known to man. Inflation's still a serious issue right now. And where else are you going to put your cash? Let's do a thought experiment, Mark.
Mm-hmm.
I personally thought crypto was going to be a great hedge. I was wrong.
This is FTX, baby. Poof.
Right.
Yeah.
I have a libertarian strand. So when I hear that Bitcoin isn't controlled by the government, that it's not linked to government printing presses, I was like, oh, that should be a solid inflation hedge. It has not proved to be that thus far. Yeah,
and gold and silver. I mean, that would be your next.
Gold and silver is great, but it doesn't cash flow. So all you're doing, you're like Scrooge McDuck. You're just hoarding and waiting for the next shoe to drop.
And then the
real estate.
Yeah, the only other one would be bullets and bottles of water, right? I mean, where else?
Yeah, and quite frankly, I was talking to Larry Yach about this. If we ever get to that level, I have a different set of skills that I get to go back to using.
Let's hope it doesn't come to that.
No, I don't want that.
By the way, I saw your Humvee. My goodness, what a tragedy! Tree fell on it.
It wasn't a hard top, so I just got to get a new top, rebend the frame, and that thing will be rocking and rolling soon.
Good. Well, I'm sure it's seen worse in its time. Okay. Yeah. No. The greatest hedge against inflation. I always come back to Bruce Norris's quote, which is, I like thinking of a house as a basket of goods, right? It's like a box of commodities. And as inflation, or, let's call this inflationary environment with interest rates rising, everything in that house becomes more valuable because the cost to replace it is a lot more expensive. So the value of the asset is not just speculative, it's very real. You could not go build the house that you bought for $150,000 in 2022. In 2032, you will not be able to go build that house for the same price.
Exactly. It's just so I forget. I know Bruce likes used houses more than new houses. Do you remember what his argument for is that? It's basically the basket of commodities argument.
Yeah.
And right now, as an investor, your greatest, here's what I know. If you stay in cash and wait, I guarantee you will lose 10%. If you throw it into the walls of a house, I guarantee you'll compete with the stock market just on principal pay down.
You had an analogy when you texted me this over the phone. We're kind of jumping on. You're like, hey, we got to go film podcasts on this because I feel passionate that this is truly the best time. And I was questioning you. You were giving me the analogy of a baseball game. Talk me through how you feel like this is kind of like 9-year-old ball.
So, because I was thinking about this, I'm just it's very probable whatever you buy at today, you're going to refi. Most people agree you're going to be able to refi at a pretty decent rate. Historically decent rate in at least 24 months. Would you agree with that presumption?
Well, first of all, I want to clarify. I mean, I think 6% interest rates are historically decent. But yes, I believe that anyone who's gone into real estate investing in the last 15 years doesn't understand that. And so, yes, getting back into the 4s and 5s in the next 24 months is entirely plausible.
Yeah, and so whether you have an interest rate at 7, at 5, at 6, your first year, it just doesn't matter. The first year of buying a long-term asset,
Yeah, you're paying a lease-up fee. You've got your title fees, your escrow fees, your cost of acquisition is such that it's not going to be. You don't buy it for year one cash flow.
Yeah, plus the underwriting from the bank, all of this stuff. Like, so you're not buying for year one cash flow to begin with. So you're going to sacrifice. If you wait now, you're going to sacrifice all the long-term benefits for something that doesn't really work anyway. And it's, to me, when I was thinking about this, it's my Bubba's 10 years old, right? And he had a pretty decent baseball season. He's my oldest boy. But that first year he had a kid pitch, I hated baseball. Like, I grew up playing baseball. I love it. I'm a Cardinals fan. But, like, sitting in that heat, watching all the balls.
Walk, hit by a pitch. Walk, hit by a pitch.
Wild pitch, steal 3 bases. Like, that was not baseball. This was like walk in a square. It was miserable. And most American parents are familiar with this. So I personally think, and I can say this from my own portfolio, investing in a long-term asset is like watching 9-year-olds baseball. It's hellacious and boring and painful. But like you went through this, with Jackson, right?
For sure.
Was it worth it now that you're watching him crush in high school?
Yeah, of course. And I think that, it's kind of like dog years. I mean, if you take like a 9-year-old ball to, high school ball, most people don't get to play in college or the pros. So it's kind of an abbreviated timeline. But to your point, the best years of an assets are in years 10 through 30. And I think the biggest mistake that I see investors making, and this is those that invest in real estate and those that don't, they don't start young enough. I believe the biggest mistake is that they should be investing when they're in their 20s so they can have a massive financial impact through either a cash out refi or just through getting the principal pay down to where you're actually getting significant cash flow and you've built up this massive chunk of equity in your 40s. So those that have waited to their 30s and 40s, that's fine, but you need to start investing now, because those that wait till they're 65 to 75, you've kind of missed the boat, in my opinion.
Yeah, it's too late. Like the stuff I bought in 06 and 07 while I was deployed, well, that I've 1031 that up to a lake condo. Like, you've done the same thing.
Mm-hmm.
But so I would say, we teach cash flow tactics, buy 2 a year for 10 years, and you're pretty much set.
Yep.
It just depends on, to your point, when you're going to start. You're going to start at 45, you're going to start at 35.
Well, mate, I had not seen this coming. Interest rates, everyone is complaining about it. They're, just moaning. Your perspective is welcomed. I love your top 4.
Do you watch the Avengers movies, Mark?
Yeah.
Okay, remember when Thanos snapped his fingers and everybody disappeared for 5 years?
Yes.
Look,
it is inevitable.
Well, yeah, but 2020, 21, it's a blip. It was. If everybody's comparing everything to those 2 years, they'll be permanently dissatisfied. Like, anytime someone's complaining, like, I'm down this much this year, I was like, oh, yeah, where are you at compared to 2019?
Yeah.
And they're like, oh, at least the same.
Yeah, no, I mean, I have investors calling and having these tough conversations, and those that are thinking, hey, is it a good time to sell? I'm like, well, what's your game plan? I mean, if you're thinking buy and sell, you should not be a turnkey investor. You should be, out there speculatively trying to flip. And hey, if you want to go do that, that's a different ball game. Turnkey investing is buy and hold, manage your property as effectively as possible to maximize cash flow. And in 20 or 30 years, you'll look back and say, oh my gosh, I have a portfolio that's worth $7 million and I only owe $2 million on it. I have $5 million in equity. Maybe I can harvest that debt now that rates are at 3%. I'll pull out $1 million tax free.
Yeah, and you have to be in the game to get those benefits.
Yep.
And then, and I have these calls where I have high net worth individuals who are crushing, making several $100,000 a year, and they're calling me complaining that they didn't get $200,000 a month from or $200 a month from one of their doors. And I'm like, you're calling me about $200 in income? Like, you're losing money right now on this call because you're not doing what you do to make several $100,000 a year. Like, please, just could you remind me why we're talking again?
Perspective.
Or remember when I said this is how this game works? Like, you need to go back and keep doing what you do. Really, you make a ton of money a month at.
Yeah, there's a lot of fear. I mean, anytime you have to have the long-term mindset, I'm not, a good analogy is not coming to mind, but, forced to wait 20 years to see the massive reward. The only thing that I think people can do is look to those that have done it. I bought the majority of my portfolio between 2001 and 2007. Well, I had a crash in 2008, 9, 10. I clearly doubled down. I waited. I paused for a little while and then waited and just bought as much as I could in 2009, 10, 11, and helped others do the same. And those that went on that journey with me are now just so thankful that they did. Testimonies are a wonderful way when you don't know where you're going, when you're unsure of, you know the destination, but you're unsure of the journey along the way. I think testimonials provide peace of mind. And I think people should be talking to those that have been there and done that, which is why I think the value in this conversation today is paramount. And I think I'll be sending this out to all of our investor base.
Sweet. Well, Jimmy, hey, if you're part of Marck's investor base, nice to meet you. And then we'll be putting it up on our stuff too.
Jimmy, it's always a pleasure, mate. Let's cross-brand this across your podcast and mine. I think people get extreme value. I wanted to keep it brief today, but we've got the top 4 points. You guys go hit it. Thanks for your time today, mate. I think it's extreme value, and hopefully we've inspired some people to go, hey, jump into real estate. You've got to do something with your cash. Jump in now, buy and hold. And maybe we've done a little bit, Marck, to help people clean up their 2022 end of year. I watched too much CNBC poopy pants. That was my real intent today. You're the best, mate. Thanks again. See you, buddy.
You're listening to Mistake-Free Real Estate Radio, the authority in passive real estate investing. No late-night calls, no clogged drains, no tenant nightmares. Take the passive investor's approach to real estate investing and trust a turnkey professional. Learn more at mistakefreerealestate.com. Until next time, remember, you don't get rich from what you earn, you get rich from what you own.